So first off, thank you everyone for joining us this Saturday and participating in Learning Saturdays, where we are committed to helping investors grow their knowledge base and make better decisions when it comes to wealth creation. So today, what we're going to talk about is a very pertinent topic in terms of bringing fixed income into your portfolios because 2025 is turning out to be quite an important year for fixed income investors. And there is a lot of hesitation to participate in this asset class because, of course, there's this perception that it's low risk, low reward, and a lot of investors have started looking at the reward side of the equation today. And that kind of makes them think that this is not a suitable asset class for them to participate in. The other big thing that's weighing on investors is the fact that the way fixed income is taxed is very different from the way other growth asset classes like equities are taxed. So that preference to look at a higher growth asset is definitely and a more tax friendly situation has also pushed investors away from this asset class. Now, beyond this, you've had a series of rate cuts this year, and investors are now questioning whether this is the right time to get into this asset class and how they can navigate this new interest rate cycle that's before them. So, in today's webinar, I'm going to walk you quickly through our agenda and we're going to look at the macro overview. That is, let's take a look at where we are on macroeconomic parameters. Then we're also going to look at what are the opportunities in this rate cycle, right? Like where are we today? What are the opportunities? How can we read yield curves? And what are suitable investment strategies for somebody who's looking at a more conservative approach to managing their portfolios? While we have this as the agenda, if you have any questions as and when I'm talking, please feel free to put it into either the Q&A section or into the chat box, and there will be a dedicated slot for Q&A towards the end, so we can take all of your questions together. So let me begin with the macro overview. So if we start looking at where we are in terms of global trends, right? One thing which is very obvious is that there has been a significant slowdown in the global economy. So you're not seeing economies grow at say 3 to 5% anymore. If you're looking at the US, there have been consecutive revisions to the forecast where they brought growth down from say 2% last year to maybe 1.5% this year. Beyond this, it's not just the US economy that's slowing down. You are seeing this cascade into Europe. You're seeing China in a slow growth path. So a lot of economies are actually struggling with meeting their target growth rates. Beyond this, I think one of the things that is fueling this low growth era is also the kind of geopolitical tensions that you're seeing. So right from the Russia-Ukraine war, I think there have been skirmishes, there have been escalations, there have been revisions in terms of political order. And even in 2025, we've had multiple instances where different countries have gone to war or there have been tensions which are unresolved, right? So typically, when you have this kind of disruption in terms of political stability, you will see cascading effects into the economic side of the pyramid as well. So, keeping all of this in mind, we also need to look at the context in terms of where economies are today in terms of being leveraged, right? So, global debts are at all-time highs. So, if you look at any advanced economy, their central bank balance sheet is highly leveraged. There's been a lot of borrowing that has come in over the last few decades. And at any point, if you're going to be borrowing or if you have a high deficit that you're maintaining with another country in terms of trade, you do have to pay that back at some point. And so we might be entering into a phase of deleveraging, which can be quite painful for economic growth as well. And of course, with all the tensions in the Middle East, one important commodity that everybody is tracking is crude oil. And here it's not so much about the level at which crude is, because one thing that is fairly clear is that even today, even at the peak of your tensions, it was not too high. But the volatility makes it very difficult in terms of planning and production, as well as estimating global supply demand. And if you're in a slowing global economy, then demand is also going to slow for oil, and that would keep prices depressed. But at the same time, there are enough factors on the supply side of the equation that are also disrupting this balance, right? So there is a need to relook at the way global commodities are priced, the way growth is occurring, uh, how sustainable debt levels are, as well as what are the geopolitical equations that different countries are maintaining. In this context, one very important macro change that every investor needs to pay attention to is the fact that the dollar is weakening. Now, why is the dollar weakening? I think this is a function of the kind of policies that the US is putting forth. If they want to focus a lot on uh, domestic growth, if they want to focus a lot on domestic manufacturing and exporting, if they want to look at revisiting their trade balances and exporting more, then they do need a weaker dollar. At the same time, because debt levels are at historic highs, you've had Moody's downgrade the US government debt. All this is moving the dollar closer to its fundamental value, if we think about it in that perspective. And when that happens, you are going to see a weaker dollar because trade now is also getting settled in different currencies. It's no longer only dollar denominated or dollar dominated trade. And that is some factor that everyone needs to really pay attention to, because while this change is not going to happen overnight and it can take even decades to play out, there are things that will upset the macro apple cart, so to speak, in terms of how the dollar is valued and priced. So now I want to walk you through some of the rate actions from central banks, right? This should give you a context in terms of what is happening across the world. So if we look at the US Fed, the Fed is actually in a very tight spot in the sense that worried about inflation, they're worried about growth as well. They don't seem too worried about unemployment. And we will look at the Fed policy in a little bit more detail later in the webinar. But essentially, they've not been able to cut interest rates. And there is a big tussle between, say, your Fed chairman versus the president in terms of where interest rates should be. So the chairman is a lot more worried about how inflation is going to play out. The president is a lot more worried about how growth is going to play out. And interest rates have been kept or maintained at this level for a while, although there is signs that the economy is slowing down. Now, the major risk is that with the tariff policies that are implemented, inflation could really spike in the US, and that might need interest rates to be at a higher level. So, waiting and watching has been the approach of the US Fed. Similarly, the Bank of England, I think, was earlier and more preemptive in terms of issuing rate cuts, but their rates are also more or less at the same level as the US Fed. If we look at the EU, they have been far more proactive in cutting interest rates. And these changes are basically your June policy changes. Um, so the EU cut interest rates by 0.25% in June, and their current rate is about 2%. And this is not just for the European Central Bank. If you look at Switzerland or Sweden or Norway or any of the other economies within the European Union, you're also seeing them move towards a lower interest rate cycle. In fact, Switzerland has been pretty vocal in terms of saying that even if they need to move interest rates into negative territory, they will be comfortable doing that. Then we have China, who's been struggling with economic growth, but they have chosen to maintain interest rates. And you are seeing a very mixed bag of data coming out from China. They're definitely on the path to recovery in terms of if we compare between 2024 and 2025. They are definitely in a better position. But the issues are deeper and they would require more time to sort of play out and give you a directional sense of where the Chinese economy is going. The again, the joker in the pack this year is going to be Japan because inflation is picking up beyond the 2% target in Japan. You're already at historic levels in terms of yields. Your Japanese 30-year bond is close to 3%. And they have maintained interest rates. And the last time Japan hiked interest rates, you had a lot of news around the yen carry trade. But with rising inflation, how much room for tolerance do they really have in keeping interest rates where they are? Now to give you a sense of like other emerging economies, right? So if we look at Brazil and Turkey, Brazil actually increased their interest rates because their growth as well as inflation dynamics are more positive and strong and moving in the same direction. And the Brazilian interest rate is at around 15%. Meanwhile, if you look at Turkey, they cut interest rates. Turkey had a very bad inflation situation for a while, and that's why you're seeing their interest rates at a record 46%. Taiwan, of course, maintained interest rates. So, like when we look at the globe in terms of where interest rates are, you can see that while India categorically is a high growth emerging economy, you're not seeing this double digit interest rate scenario there. We're actually on a much better wicket. Our interest rates today are at 5.5%. We've actually been able to cut interest rates while the economy is slowing down, whereas many other economies are not able to immediately cut interest rates because of other concerns that they're weighing in their minds. Okay, so coming to the Fed, right? I said we would discuss this in a little bit more detail. And this is the latest dot plot. So every alternate Fed meeting, they come up with something known as a summary of economic projections, which tells you roughly where the Fed as a committee is seeing interest rates move, where they're seeing major macroeconomic parameters like growth, unemployment, and inflation. So on the left, you have the dot plot, which is a visual representation of how each committee member voted for the trajectory of interest rates in 2025, 2026, 2027, and going forward in the long run. So there are a few interesting things in this dot plot. So one is a majority of committee members do still expect interest rates to move down, right? So in 2025, and definitely in 2026, you have no one who's expecting interest rates to stay at the same level. But when you look at the long run interest rate, you are seeing it to be at a higher level, maybe close to 3.5%, 4%, or anywhere between 3 to 4%. Whereas previously, the expectation was that their long run rate would be closer to 2.5%. Now, I've also put in a table with the changes in the summary of economic projections because we had an SEP in December last year, then in March this year, and in June this year. So in December, the expectation was that the US economy would grow at 2.1%. But you could see by June that forecast has been slashed quite a bit, and you're actually expecting the economy to grow only at 1.4%. So this clearly indicates that your recession risks have increased, right? Because you're expecting a significant slowdown in economic activity. Then when we move on to inflation, you're actually seeing that the inflation forecast has gone up by 0.5%. And the Fed, again and again, is still talking about the path to 2% inflation, right? They are very fixated on bringing inflation down to 2%. And if your forecast has gone up rather than down, that means this path to 2% inflation is actually going to take much longer. Now, beyond this, we also have your unemployment metrics. And here, what is coming out from the tone and the way that the Fed is talking about unemployment, even though your expectations have inched upwards from 4.3% to 4.5%, the Fed seems pretty sanguine in the sense they're having some level of tolerance for unemployment to go up because they still think that today's level of unemployment is lower compared to the historic levels of unemployment, right? But so you've got lower growth, higher inflation, and higher unemployment. And this is not actually a good combination, right? Yet your interest rate trajectory is more or less the same. And the expectation is that you're looking at the Fed funds rate to move to 3.9% by the end of the year. And that means we're looking at least two more rate cuts, at least according to what Fed members think. So now let's move to the Indian context. India is still the fastest growing economy in the world. Our growth is expected to be anywhere between, say, 6.2 to 6.5%. But what that being said, our growth is slowing down and it's not at the level that we want to grow at because there's a very clear uh, expectation that the Indian economy should grow at say 7.5%. But to do that, you need a lot of policy intervention. You need to move a lot of levers to make that happen, and you need more support to ensure that growth is sustainable at those rates. It can't be a one-hit wonder or be as a result of some short-term policy tweaking. Uh, that being said, India is exposed to a lot of external risks. So when we listen to what the RBI is saying about the Indian economy's growth, the one thing that stands out is that domestic activity seems to be pretty strong, but external risks are what is putting pressure on India. So if you're having a global economic slowdown, there is no doubt that the Indian economy will also be affected by this global slowdown. And the way things are at this moment, as well as how different economic institutions are projecting global growth, it does seem like there are a lot of external risks which we aren't able to evaluate, which could affect our growth trajectory. So moving on to the factor that we looked at across the world in terms of how our balance sheets leveraged, I think India is actually doing very well on this. We have been on a path to consolidate our fiscal deficit. There was an initial trajectory that was issued, but then because of COVID, that trajectory was revised. And if we look at last year's spending, we actually were ahead of the curve. And this year also, it looks like we're on track. There are a few factors that are pushing your fiscal deficit numbers up and down, but that will eventually settle down and play out in some time. If we look at our policy stance, right, I think one word summarizes how the RBI has been in this rate cut cycle, which is preemptive. Uh, we were early in cutting rates, even when we were in the neutral stance. Then you had another rate cut and a shift in stance. And then you had two rate cuts, which were more preemptive in nature. So you had like a mega rate cut that happened in June and a shift in policy stance. So now the way the RBI is looking at economic activity as well as inflation risks, as well as where the global economy is, I think you're at a point where the stance is neutral and it allows the RBI to act in any direction. Now, this is where I think people have started questioning whether fixed income can be an asset that works for them or not. If we look at another parameter, which is bank credit and lending, growth actually remains subdued in this category. The basic idea being that there were a certain level of restrictions that came in last year, and now the RBI is stimulating the economy through different policies to ensure that lending activity picks up. We talked about dollar depreciation. So conversely, you will have the rupee appreciate against the dollar. Now, you haven't seen too much of this because there's been some level of stability that has been maintained in the exchange rates to ensure that you have a more visibility in terms of planning things. And if we look at what revisions have been made to our inflation and growth projections, one thing is clear. So initially, in the early part of 2025, the RBI reduced the growth forecast and maintained the inflation forecast. But as we've moved into June, you're seeing that the inflation forecast is actually going down further, whereas growth has been more or less at that revised lower level. So where are other economic institutions projecting India's growth? So let's first look at what are some of the key actions that the RBI took in 2025. And if we see, you had from January to June a lot of open market operations. which is essentially a tool that the RBI uses to infuse or reduce liquidity in the market. So the RBI participated in bond buying through this entire window, and the key thing has been that when the RBI purchases a lot of bonds, you see more liquidity coming into the system. So last year we were actually in liquidity deficit, and this was something that needed immediate address from the central bank. And the OMOs essentially allowed for that movement of liquidity from deficit to surplus, right? In terms of rate cut actions, you had the repo rate cut from January to July. So first rate cut happened in February, the second one in April, and then your double rate cut in June. And so the total sum has been about 1%. So your repo moved from 6.5% to 5.5%. And if we look at what the RBI has in store, right? So they, again, because I said that the word that we can use to describe policy actions this year has been preemptive, they've also been preemptive in issuing a cash reserve ratio cut or a CRR cut. This essentially allows banks to lend more and keep more liquidity in the system. So clearly the RBI is not restricting themselves only to the repo rate, and they are trying to maintain liquidity in the markets through other policy tools as well. Now, the interesting thing about the CRR cut is that it doesn't come into effect now. It comes into effect between September and December, so that you have durable liquidity in the financial system throughout the year. So now I want to take a quick look at the repo versus inflation. And so you have your repo rate in blue and your inflation rate in orange. And the interesting thing that you're going to notice here is that when you have a rate cut, your inflation reacts with a little bit of a lag, right? And if we see where we are in terms of the differential between your repo rate as well as your inflation rate, there's a huge differential. Your repo is at 5.5. Your inflation rate is, your latest inflation rate has been closer to 3%. Sorry, below 3%. And your projection is closer to 3.7% for the rest of the year, which means that you are going to have a couple of low inflation readings, definitely below the RBI's target of 4% on ideal level. So inflation is yet to pick up, and that actually creates some policy room for the RBI to cut interest rates further if required. Now, when we look at the yield curve or where the yields are for Indian bonds, we've plotted some long-term bonds in terms of 20, 25, and 30 years. So that's your green, blue, and purple lines on top. And then you have some shorter and medium-term bonds in terms of your 5 and 10 years. So if we look at this 1% rate cut and where has the transmission really happened and where has it not happened yet, what stands out quite clearly is that your shorter end of the curve, that is your 5 year as well as your 10 year, have reacted a fair amount. So the 1% cut, so the 10 years say went from being 6.9 percent to about below 6.5. So we're at 6.3-ish today, right? Similarly, your 5 year has also reacted quite a bit and it's closer to 6% today. So that 1% transmission has really happened in these two categories. Where it hasn't happened is in the longer duration bonds. So your 20, 25, and 30-year bonds are more or less at the same level that we started off in 2025. But structurally, there's a lot of things that are working for the Indian economy. We are better in terms of economic growth. We are better in terms of inflation management. We are better off in terms of fiscal deficits. So keeping all of these structural changes in mind and the fact that India has been included in global bond indices makes Indian fixed income securities a global investment destination, right? So this essentially shows that the risk reward in Indian bonds, especially duration bonds, is much more favorable today than it was earlier. And there is merit in looking at duration even today, especially because the long end of the curve has reacted in the opposite direction to the short end of the curve. So let's look at where the growth and inflation projections are as well. So if we look at the growth and inflation projections, you're seeing that we're still expected to grow at 6.5% according to the RBI, whereas your inflation numbers are expected to be below the target of 4% at 3.7%. And this is actually a revision from, say, the projections that they showed us in the April meeting. So if we look at how this is playing out, the slowdown is expected to happen a little bit later in the financial year, and inflation is also expected to pick up only later in the financial year. Right. As of now, your Q1 numbers are supposed to be less than 3%, which is very low. And Q2 and Q3 are also below your target of 4%. It's only Q4 numbers that look like they're going to pick up. And if we look at other institutions in terms of where they're projecting India's growth, I think the IMF is standing at the lowest estimate of 6.2%, whereas your World Bank as well as RBI are showing projections at 6.3 and 6.5%. So this brings us to the opportunities in this market, right? So there's an interesting dynamic between interest rates as well as bond prices, and they have an inverse relationship. So we can visualize this in the form of a seesaw, where when your interest rates go up, your bond prices actually fall, right? And this is because newer bonds are issued at higher interest rates and become more valuable. So the demand for new bonds increases and old bonds reduces. But there's already an existing supply of old bonds, which means that the risk reward can only adjust with the bond prices reducing, right? So then the investor's yield picks up, and then you're all on par with the newer bonds that are issued in the market. So if this is how it works when interest rates go up, then the opposite is also true. So when interest rates fall, your bond prices actually move up and appreciate in value. We are in a situation where we've had interest rates move down, but your bond prices haven't reacted yet, especially in the long end of the curve. So if we think about the opportunities that are there, there is definitely opportunity on the duration side, but interest rates actually have far more reaching effects than just changes in bond prices, right? So when your interest rates go down, your interest burden for individuals can also go down, which means that your EMIs may reduce. You may also be able to refinance at lower costs. You may be able to prepay loans and become debt free in this cycle. For investors, I think the basic idea is that you can look at how these bond prices are going to react and make a tactical allocation to fixed income as well. On the business side, rate cuts are essentially meant to stimulate economic activity. So you can see lower cost of capital. So there is an opportunity to raise capital at lower price costs. You may also be able to see a boost in consumer demand. So it's not just the RBI policy, but you've also had a consumption push in terms of the tax relief that has come in. And there is a lot of news about the GST Council trying to rationalize rates and bring in more structure and efficiency into that. So that could also be a trigger in terms of consumption demand, right? And in lower interest rate eras, you typically see more easy funding that occurs. So what is it that actually works in a downward cycle, right? So if you look at gilt funds, you have those that take a duration call can actually give you good returns when your yields fall, right? But there is a lag between, say, an interest rate change and a yield change because markets take time to adjust and they're not factoring in only the interest rate cut, they're also taking into account other factors that might affect yields. You also have dynamic bond funds where the manager takes a duration call. And then you have target maturity funds that allow you to participate in a very passive way into this market. And of course, you have banking and PSU as well as corporate bond funds, where you have a fairly high quality portfolio, but not too much duration on that. But you might get a better yield because the first set of bonds that will react to any interest rate cuts are, of course, your government securities. Only then does that transmit into other aspects of the yield curve or other this segments where you have more credit risk. So when rates fall, you have uh, prices increase, and then your long duration funds tend to deliver higher returns. This is the paper process in terms of how this works, right? So the opposite is also true. So when your rates increase, or if your yields also increase, then your duration bonds lose value, and then you suffer losses. So this is something that maybe investors have experienced this year, because if you've taken a duration call, you will see a slightly negative return on your portfolios today. And this is because the yield curve has not reacted according to the rate cuts. It has actually worked in the opposite direction. So there's a need to kind of assess the risk reward today and understand that it's actually more in favor of the investor today than it was earlier in the year. So this is a quick look at how yield curves can be structured. So your when you see a upward sloping yield curve, that is considered to be a normal yield curve. And usually you see an upward sloping yield curve when the economy is growing, when inflation is also expected to rise. So a flat yield curve is basically one that you see when you're not sure about the growth rate and the direction. So if we looked at India's yield curve last year, we had of flattish yield curve. So across different maturities, we were more or less getting the same rate of return. Through 23 and 24, that was the case. You have inverted yield curves, which are usually seen as a recession indicator. And that would essentially mean that your short-term yields are much higher than your long-term yields. And in the US, this has been something that has occurred through the COVID years, but you've still not seen that recession come in. And usually that recession happens, say, within 12 to 18 months of seeing an inverted yield curve. You also have steep curves where you see a sudden sharp rise, and this could be because of any changes to your growth inflation dynamic. So this chart basically plots where the yield for each maturity is in terms of the India yield curve, right? So if we look at where our curve is today, it's upward sloping in terms of maturity versus yields. Last year we had a much flatter curve. Pretty much everything was say in the 7 to 7.2% range. Whereas this year we're at like say 5.5 to 7.1%. Uh, so this yield differential of 1.5% actually shows us that there is some steepness in the yield curve, and there is some movement that can actually happen in the shape and the structure of the yield curve. Another thing that has really weighed on a lot of investors is the India-US rate differential, right? So last year we had almost a 3% differential in terms of interest rates between the US and India. Whereas this year, uh, that has reduced by almost 1%, and we're roughly at a 2% interest rate differential. Now, this is a historically low difference to have between India and US, which is one of the reasons why a lot of bond market analysts are expecting yields to stay where they are. But earlier in today's presentation, I had talked a lot about how the US dollar is fundamentally moving towards a fairer value. You're also seeing US yields pick up because of the level of debt that the US economy has. And at the same time, we also need to look at the underlying economic fundamentals. And there is some sense that the dollar is not as strong as it used to be before, right? And when all of these changes are happening, then we need to question what a fair interest rate differential is. And one thing that we've noticed is that every time the dollar weakens, you see flows coming into emerging markets, right? So FII flows move according to where currency strength is. So now I'd quickly like to walk you through a couple of rate call scenarios from the Fed. Now, one is that the Fed takes a more conservative path, where they're going to be more cautious because they're worried about inflation. They don't really cut interest rates, or it's very limited in terms of looking at how the tariffs are going to play out, how inflation is going to play out, keeping the labor market more stable, and sort of paying attention to geopolitical risks. Then, of course, there are expectations, especially from different houses, on how the Fed has to cut interest rates because economic activity has slowed significantly. Their projections are also showing a very similar picture. And if this happens, then you could see even three rate cuts this year beyond what dot plot showed us in terms of, say, September, October, and December being months where the Fed is cutting interest rates. So now let's compare where India is versus where the US is. So if the inflation outlook turns out to be below our projections, it will open up policy space. This is something that the RBI governor has openly come out and said, essentially indicating that if you see more downward revisions to the inflation outlook, and there are enough drivers to push this because if we track where food inflation is, where food prices are, where reservoir levels are, what kind of agricultural output we're expecting, then I think it's pretty clear that you are heading into lower interest rate territory because you are seeing more room for inflation to actually go down. And if we look at the Fed, they are still in wait and watch mode, which means that they are more worried about the effect of tariffs. They are more worried about how to bring inflation down. They're more worried about the dollar weakening because that could also push inflation up. And all of this can have material consequences in terms of how the Fed views policy actions. Now, this essentially shows us that perhaps the rate cuts that the Fed has to do, especially given their economy, that economic activity is slowing down and unemployment risks are inching up, they may be forced to cut rates even if inflation is high. And when that happens, you could see that differential between India and the US sort of widen. And this is essentially a question of the Indian economy being more preemptive and proactive in cutting interest rates versus the Fed being more precautious and prudent in moving their interest rates. This brings us to your investment opportunities. And I think as an investor today, there are many ways that you can actually look at a more an investment strategy from typically conservative asset classes like fixed income and precious metals, and how you can play that according to the kind of investor that you are. So duration calls are going to be volatile. Any investor who's already made a duration call this year would have experienced that volatility. It's part of the cycle. It's not something that is unusual. It should not be an indicator that you have made a bad investment decision. It is difficult to see negative returns from fixed income, especially because we are usually insulated from it in the fixed deposit format. But what we need to understand is that this is opportunity knocking twice, and that is something that we need to be tuned towards. For investors who are not so particular on having that volatility from fixed income, then an accrual strategy might actually work. The basic idea being that accrual gives you the flexibility to move from one asset class to another asset class, not necessarily in a tactical way. Whereas a duration call is always going to be a tactical call, and you are going to enter and exit based on where that opportunity presents itself. And there is a certain timeline uncertainty in a duration call, whereas accrual calls can be more opportunistic in nature. And consequently, your duration is going to give you a higher risk reward payoff. And your accrual calls are actually not going to give you too much on the reward side. They are more of an opportunity based. So, for an investor who wants to participate in different opportunities, plus can handle a certain level of volatility, then duration plus accrual makes great sense. For an investor who can handle a lot of volatility but prefers to have exposure to multiple asset classes, then I think it's clear that duration plus precious metals should be a strategic pair for you. And if you want to avoid some of that volatility and you want to also avoid being too much in fixed income, then you could look at accrual plus precious metals. Now, because accrual is going to give you a lower return, then your tax burden on that is also going to be slightly less. So before we close, I'd like to talk to you about Milestones to Wealth, which is a program that we are running, where we like to help every investor think big and take them from where they are to their first crore in financial savings, and even beyond that if you're at the 1 crore milestone. So, what is our promise in M2W? We would be very happy to handhold you through your decisions on your portfolios. We would be very happy to guide you through the ups and downs in the market. And of course, we are committed to Learning Saturdays and similar programs where we educate investors on what's happening in the markets, how they can develop the right mindsets and behaviors to achieve more. And this also flows into the goal that we have in terms of coaching and mentoring investors to get to their big milestones and to dream big and achieve big things. But the most important thing is, while all of this is there, we also need to have a process by which we measure, which is why milestones are there. And we work with investors in sort of looking at what is the timeline in which they can achieve certain milestones and how we can advance those timelines through the right behaviors, the right participation, and the right actions at the right time. So, what is the outcome for an investor who's enrolled in M2W? You end up with a lot more financial discipline. You develop a growth mindset which allows you to achieve things not just within M2W but in life as a whole. It also helps you develop investment conviction, which is very important for scaling up and wealth creation. Because unless you are convinced that an investment is working for you, you're not going to be able to participate at the market bottoms. And when you participate at the market bottoms, you actually take less risk and earn potentially more returns, right? We are also able to give you wealth maps, which are a very powerful tool in terms of documenting where you are and deciding how you're going to get from where you are to where you want to be. And we ensure that you experience and participate in such a way that you're always scaling up and you're unlocking your full potential. So, a quick thing about Finesse. We write a monthly outlook, which is available on the iThought website. This should give you insight into what the current trends in the fixed income market are. We also conduct a webinar every month, similar to what we've done today. And we help investors enrolled in M2W with product selection, portfolio construction, as well as investment reviews. So if you want to study your portfolio, understand if your asset allocation is right, if the kind of risk that you're taking in your portfolio is aligned with the kind of risk you want to take, as well as want to know if you're in the right products and want to build your portfolio, then M2W is a great way to do this. We predominantly work with mutual funds. We also have some bonds on offering that are available to investors. So with that, let me open up for questions. In case you want to know more about Milestones2Wealth, please feel free to write to us at info@milestones2wealth.com. You can also find out more about the program on our website, or you can just quickly drop us a WhatsApp message on 9677000613, and we'll be happy to get back to you as to how we can work with you in getting through your 1 crore journey. Thank you. I hope to see you at another webinar. I'm going to be closing it, and have a great weekend to everybody who's here. Okay.